Tyler just bought his first rental property in Hamilton. He's about 20 minutes away from waving the keys at his buddies and calling himself a real estate investor. His best friend Liam took the exact same 110 grand and dropped it into XEQT. No keys, no tenant, no story to tell at the cottage, just a confirmation email. They both think they made the smarter move. They're both wrong. And the reason they're both wrong is what makes the next 20 years so brutal to watch. Tyler forgot to count the hours. Liam almost forgot what the Canadian tax system can do to people who don't plan around it. Run the numbers for 20 years and the gap will mess with your head. Stick with me until Chapter 8 because there's one $300 a month decision that decides this entire thing. And almost nobody talks about it. Let's run the math. Same starting line, same paycheck, same age. 20 years of brutal Canadian truth. Vacancy, tax bombs, mortgage renewals, the whole mess. Let's run it. Here's exactly what you're going to walk away knowing. The real cash flow on a Canadian rental after every hidden cost. The mortgage renewal cliff that's catching Tyler off guard. How the TFSA quietly destroys the principal residence exemption. The Canadian capital gains tax bomb at sale. And that one $300 a month move that wins the whole thing. If we haven't met, I'm Jay. I make videos for Canadians who are sick of personal finance advice built for Americans. This channel runs Canadian numbers, Canadian rules, Canadian reality. Quick housekeeping, this is not financial advice. Always do your own research and talk to a licensed Canadian advisor before making any moves with your money. Cool? Cool. Meet our two players, both 32 years old, both earning 75 grand a year in Hamilton, both sitting on $110,000 they spent 5 years saving. Same starting line, different play. Tyler takes his 110 grand and puts 20% down on a $550,000 three-bedroom rental in Hamilton. 25-year mortgage, 4.5% fixed. Rents $2,800 a month. On paper, beautiful. Liam takes the same 110 grand and dumps it into XEQT. TFSA first, RRSP second, taxable account if there's anything left. Throws in $500 a month on autopilot, doesn't tell a soul. Day 1. Tyler walks out of the lawyer's office with a set of keys and a property he half owns. The other half belongs to a bank, but nobody at the barbecue is going to mention that part. By the end of the week, every friend, cousin, and coworker has heard about the rental. 3 of them say they want to do the same thing. 2 ask if they can see it. Liam, meanwhile, opens his brokerage app once and sees that his 110 grand is now worth $109,892. He shrugs, goes back to making a sandwich. Tyler has a tenant, a story, a property he can drive past on the way to work. Liam has a brokerage account and a sandwich. Socially, this isn't even close. Tyler is winning by a country mile. Tax time hits. Tyler claims mortgage interest, he claims property tax, he shaves a few $100 off his bill. His accountant says, "Good job." Tyler walks out feeling 10 feet tall. Liam logs into his account once that quarter, sees the number went from 110 to about 112, closes the app, doesn't tell anyone. There's nothing to tell. There's no story in a slightly higher number. If the story ended here, Tyler wins. You've got the asset, the brag, the tax refund. But the story doesn't end at year 1. It ends at year 20, and year 5 is where everything starts to bend. Fast forward 3 years. Tyler has collected rent every single month. Almost. We'll get to the almost. On the surface, the math is gorgeous. Gross rent over 3 years, 100 grand and change. Mortgage payments over the same 3 years, about 88 grand. Looks like 12 grand of cash flow before anything else. Tyler is feeling brilliant. He hasn't subtracted the actual world yet. Property tax in Hamilton runs around $4,500 a year. Landlord insurance is roughly $1,800. Times 3 years, that's 19 grand gone before he's fixed a single faucet. Year 2, the water heater dies on a Tuesday night. $1,400. Tyler doesn't sleep, then drives across town the next morning to meet the tenant before work. 6 months later, the flat roof patch fails after a Hamilton ice storm. $3,200. Then the tenant gives notice. 1 month vacant. $1,800 in lost rent. $600 to clean and relist. Real net cash flow over 3 years, after every actual cost, -5 grand. Tyler is paying to own this rental. The hope is that appreciation eventually makes up for it. The hope. For now, he's checking the property every weekend and writing checks. And that's before we count a single hour of his time. Tyler is running a part time job that pays him negative money. Try selling that pitch on Indeed. Meanwhile, Liam has done nothing. Bought XEQT, set up the 500 a month auto contribution, looked away. His portfolio at year 3 is sitting at about 165 grand. But the rent check is the number everyone shows you. Here's the number nobody shows you. Honestly, this next part is the one most Canadian landlords learned the hard way. Vacancy. The average Canadian rental sits empty about 1 month a year. That's a full mortgage payment with zero income to cover it. Then add cleaning, listing fees, screening time, maintenance and repairs. Budget 1 to 2% of the property value every year. On a $550 house, that's between $5,000 and $11,000 annually. Some years it's a faucet, other years it's a furnace. Capital expenditures. Roofs last 25 years, furnaces 15, water heaters 10. These come in chunks of 5 to 15 grand. If you're not setting money aside for them every month, you're not running a business, you're running on luck. Property management. If Tyler hires it out, that's 8 to 10% of monthly rent gone immediately, roughly $250 a month. If he does it himself, he's working a second job for free. Look, before you throw your phone across the room and tell me real estate is the only real wealth, hang on. I'm not anti-real estate. I'm anti-running the fake numbers. Stay with me. It gets better. Bad tenants. The Ontario LTB takes 6 to 12 months to evict. Meanwhile, your tenant lives rent-free and you eat every cost. One bad tenant erases a full year of profit easy. And here's the one most Canadian landlords miss entirely. When Tyler eventually sells this rental, the capital gain is taxable. 50% gets added straight to his income that year. There's no principal residence exemption on a rental, ever. If Tyler sells in 20 years for a $400,000 gain, 200 grand is taxable income. At his marginal rate, that could be a tax bill of 80 to 100 grand, gone to the CRA. Liam, in this same 5-year stretch, has had 0 phone calls, 0 repairs, 0 tenants, 0 LTB hearings, 0 capital gains exposure inside his TFSA. Because the TFSA has no tax. That's the whole point. None of this shows up on day 1. It all shows up eventually. And speaking of, wait till Tyler's 5-year mortgage renewal hits. Canada doesn't do 30-year fixed. The new rate is the new rate. Quick recap if you just joined. Tyler bought a Hamilton rental. Liam bought XEQT. Year 5 is hitting now. And year 5 is when the wheels start to come off the rental playbook. By year 5, Tyler is on his 3rd tenant. He's replaced the roof, 14 grand. Dealt with a plumbing emergency that cost $2,000 and spent 1 month vacant between tenants, again. He's bumped rent to $30.50 a month, which helps, but property taxes are up, insurance is up, and Hamilton just hiked its assessments. He's running just to stand still. Then the renewal hits. Tyler's 5-year fixed at 4.5 rolls over to 5.5. Sounds small? It isn't. His monthly mortgage jumps about $240. Nothing he can do about it. His actual cash-on-cash return, the money he pockets relative to the money he's put in, is now hovering at 2 to 4%, not the 15% he told his friends about at the cottage. Quiet thing about year 5, Tyler stopped bringing up the rental at the cottage. Nobody asks anymore. Not because they don't care, because his answers got shorter every year. Liam, meanwhile, has put in $500 a month for 5 years. His portfolio is sitting at about $210,000. He still hasn't told a single person. He's still playing video games. Now, here's where it stops being a fair fight on the inside. By year 10, something quiet happens. Most landlords don't even notice it, but it changes everything. Year 10. Tyler's property has appreciated about 3% a year and is now worth around 740 grand. Mortgage balance? About 410. Equity? Roughly 330,000. Sounds amazing. But here's the cost. Beyond the original $110,000 down payment, Tyler has put another 35 to 50 grand out of pocket over a decade. Negative cash flow years, capex, and that lovely renewal bump. Liam's portfolio at year 10, with the $500 a month going in like clockwork, roughly $365,000. Total in, 170. The rest is pure compounding. On paper, Tyler looks ahead because his equity number is bigger, 330 versus 365 minus contributions. But notice the shape. Tyler's curve is flattening. Liam's is accelerating. That's compounding doing its thing. Now here's the part most Canadian rental investors never run the math on. Every dollar of growth inside Liam's TFSA is tax-free. Forever. Every dollar of Tyler's rental income for the past 10 years was taxed at his marginal rate. If you're under 35 right now and you're choosing between a rental property and maxing your TFSA, this is the screenshot moment. The TFSA is doing work your rental can't match legally. Once Liam maxed his TFSA, he started layering RRSP. Every contribution gave him a tax refund. He reinvested every refund. That's leverage too, just the boring tax-deferred kind. Now strap in, because year 20 is where the real number comes out. And that $300 a month decision I teased at the start, you're about to see exactly what it does. 20 years, 2 strategies, 1 conclusion that's going to surprise both sides of the comment section. Let's run it. If you just joined, Tyler bought a Hamilton rental, Liam bought XEQT. Here we go. Tyler's Hamilton rental is now worth about $1,050,000. His mortgage is almost gone. His equity sits around $1 million. On paper, the man looks rich. Tyler doesn't have $1 million in cash. He has $1 million in equity. Selling triggers a capital gain, about $450,000. Half hits his income that year. Tax bill, $90 to $110,000. Gone. Tyler's actual net at year 20, call it $900,000 after the tax bill. Add in 20 years of cash flow, maybe another $60 to $100,000 on top, after accounting for every repair, every vacancy, every rate bump. Liam's portfolio at year 20, $995,000. Call it $1 million. $600 sits in his TFSA, tax-free forever. $300 in his RRSP, taxed only when he pulls it. The rest taxable at way friendlier rates than rental income. When you do the actual after-tax math, they're a hair apart. Tyler $960, Liam $995. 20 years, 2 completely different lives, almost the same net worth. But Liam is about to break the tie. How they got there is the whole point. Tyler worked for his. Liam waited for his. Tyler took on hundreds of grand in debt, all on one Hamilton zip code. Liam owned thousands of companies, never lost a Saturday. Here's what I promised you in Chapter 1. $300 extra a month. That's 1 coffee a day. If Liam had thrown in $800 instead of 5, his portfolio at year 20, $1.2 million. $200,000 more than Tyler ever pulled out. $300 more in stocks just compound. $300 more in real estate buys you exactly nothing. To do more real estate, Tyler has to buy another property, new mortgage, another tenant, double the work. Before the real estate crowd loses their minds, I'm not done. If I only showed you the downsides of being a landlord, I'd be doing what every stock bro does. Let's be honest about where real estate actually wins. Leverage. Tyler used $110,000 to control $550,000 of property. Liam controlled $110,000. That 5-to-1 leverage is real wealth-building power, especially in a rising market. Now here's the Canadian secret. There's a strategy called the Smith maneuver that lets you essentially leverage into the stock market with the same tax-deductible interest treatment Tyler gets. I made a whole video on it, link in description. Forced savings. A mortgage payment is automatic. You don't get to skip it. You will pay it. Liam's $500 a month? He can pause it anytime. Most people do when life gets hard. House hacking. Buy a duplex or triplex. Live in one unit, rent the others. Tenants pay your mortgage. Works in Halifax, St. John, even parts of Hamilton if you know where to look. Stocks can't do that. Principal residence exemption. Live in the house you own, the gain is tax-free. CRA doesn't touch a dollar. The one tax shield that actually competes with the TFSA. Only on your primary home, not a rental. Markets where the math works. Edmonton, St. John, parts of the prairies, where rent-to-price ratios are still above 0.8%, real estate can absolutely beat the math we just showed for Hamilton. Local market matters a lot. Inflation hedge. Both real estate and stocks beat inflation long term, but rents reprice almost immediately. Stock dividends take longer. If you're allergic to inflation, real estate has a real edge. Real estate isn't a bad investment, it's a misunderstood one. The same way the TFSA is misunderstood by the real estate crowd. They both work, they both fail. Depends entirely on whether you ran the actual numbers for your situation. The real trap isn't real estate. It isn't stocks. It's picking either one based on what your uncle said at Thanksgiving or what a YouTube headline screamed at you, without ever running the real numbers for your own situation. Next time someone tells you real estate always wins or stocks always win, ask them one question. Did you include everything? Because the answer that includes everything is the only one that matters. What if you did both? What if Tyler buys a house and uses it to invest in XEQT at the same time? That's the Smith maneuver. The Canadian government basically lets you. Full breakdowns in the description. Drop your province in the comments below. I'll tell you what most rental investors in your market are getting wrong, and what your TFSA could be doing instead. I read every comment in the first 48 hours. If this saved you from a 5-figure mistake, subscribe. We run the real Canadian numbers on real Canadian situations every week. No American hand-me-down advice, no fluff, just a math that actually applies to your life. I'll see you in the Smith maneuver video, or whichever one the algorithm throws at you next. Either way, run your own numbers. Always. Take care, friend.